This video, created by the University of Missouri Agricultural Business and Policy Extension Program, provides information about crop share leases. Share leases make up about 20% of farmland leases in Missouri. Share leases have become less common over time, but are still important to understand. They remain a very viable leasing option to help meet the objectives of both property owner and tenant. A crop share lease is one where the landowner and the tenant split the crop produced in proportion to their share of contributed expenses. The landowner typically provides all the costs associated with land and is credited a return or rental rate on the land. The tenant frequently provides the labor, field equipment, and fuel for the equipment. The tenant and landowner either split remaining input expenses, or one party assumes responsibility for those other expenses. Who covers what expenses sometimes becomes a point of negotiation in the lease. Share leases share both the risk and the reward of crop production. Crop price and yield risks are shared between landowner and tenant. Share leases can be an equitable way to lease farmland. They present benefits and challenges. Share leases benefit tenants by requiring less capital than a cash lease. Tenants with share leases do not make cash rental payments and are not responsible for the portion of other input expenses paid by the landowner. The landowner must have sufficient cash to cover shared input expenses. She also needs to be comfortable reviewing input expenses she will pay. She should be able to understand any invoices she receives. Often the landowner allows the tenant to sell her share of the crops. But some landowners choose to market their own share. If the landowner markets her share, she needs to work with the tenant to agree upon where and when her share of the harvest is to be delivered. Crop share agreements require greater attention to detail than do cash leases. For example, the tenant normally purchases and applies crop inputs. Records and invoices need to be saved and shared with landowners so that the landowner can pay their share. Good communication between landlord and tenant fosters a good crop share leasing relationship. Opportunities for disagreement arise if the landowner gets a bill for an expense that is higher than expected. Tenants can prepare the landowner for higher expenses by communicating increasing input prices before sending the invoice. Unexpected expenses can also cause conflict. For example, a crop harvested at a higher moisture content may require more drying and higher fuel costs. The decision of when to harvest was made by the tenant, but the expense of drying may be shared by both. How to share unexpected expenses should be discussed prior to the lease agreement. In some share leases, the landowner reimburses the tenant for inputs. This can create a financial strain as the tenant must float the expense until the landowner pays. Other share leases have the landowner directly billed for crop inputs. A share lease might be considered by some input providers as a partnership, leaving both parties of the lease subject to each other's liability. A good share lease should clearly state that it is not to be considered a partnership. Share leases also impact government program participation. In a cash lease, all government payments are to the tenant. With crop share leases, the landlord is eligible for government program payments. Share leases may impact taxable income in several ways. Landowners may or may not be considered a material participant in the business. If they are material participants, they pay self-employment tax on net income and may have reduced Social Security benefits. Share leases enable landowners to manage taxes by timing when expenses are paid and crops are sold. Most farmers purchase government-subsidized multi-peril crop insurance. With a crop share agreement, the landlord and tenant typically purchase separate crop insurance policies for their share of the production. They can use different insurance companies and purchase different coverage levels. The risk management agency that oversees crop insurance prefers that crop share agreements be written so there is a document verifying insurable interest in the crop. Consult a crop insurance salesperson for other insurance implications of crop share leases. Written leases are always a good practice. Putting it in writing is even more necessary with crop share leases because so many decisions need to be clarified before production begins.